Hello and welcome to the Wake Up Call podcast. In this episode, I spoke with Dr. Jeff Hummel about a potential U.S. government default and debt repudiation. Every word Jeff says over the course of the interview can be clearly understood, but unfortunately there was an audio issue and Jeff's audio has an echo throughout the interview. I had similar audio issues twice before the episode immediately before this one, and as I said during that episode, I thought I had done what was necessary to correct the problem. Evidently, that was not the case, so I've since switched to different recording software in hopes that will prevent this issue from ever arising again, and the problem has not occurred again since this episode. Again, every word Jeff says can be understood. Dr. Hummel is a professor of economics at San Jose State University. He is the author of the book Emancipating Slaves, Enslaving Free Men, A History of the American Civil War, and of several articles related to U.S. government debt and a potential default, including why default on U.S. Treasuries is likely, some possible consequences of a U.S. government default, and the inevitability of a U.S. government default, the latter of which he co-authored with David Henderson. You can follow his work at his faculty page at sjsu.edu/economics/faculty/jeff.hummel.html. For more information, please see the show notes page for this episode at wakeupcallpodcast.com/default. So I like to start off shows with definitions just to make sure that everyone's on the same page. So let's start that way. What exactly is the U.S. national debt, and then what is the U.S. government deficit as well?
The current national debt, depending, there are two ways of looking at it. The outstanding debt is about $14 trillion as of March 2016, technically $13,954 billion. If you throw in the Social Security trust funds, it gets up to $19 trillion, which is more than 100% of GDP. And the deficit, is just the amount annually by which the debt increases, the difference between government expenditures and government revenue.
All right, and it seems like the $19 trillion figure is the one that we hear most often when the mainstream media discusses the debt. But what would you say is the best number to use right now? Because I know Lawrence Kotlikoff from Boston University refers to the fiscal gap and cites a much, much, much larger number. So what number should we look at for this?
Okay, well, it depends on what question you're asking. If you're asking the question of how much does the U.S. government currently owe to the private sector, then actually the smaller number is the better number, the $13.9 trillion. If you're asking the question, but that's backward looking. If you're asking the question about what is the difference between expected future government revenues and expected future expenditures, then the larger number is way too small because the Treasury debt only represents one set of formal promises that the U.S. government has made. There are also these implicit promises embedded in mandatory spending for Social Security, for Medicare, and for Medicaid, and a few other less significant government programs. And if you look at that, you get what's known as the fiscal balance or the fiscal imbalance, and estimating it is tricky because it can vary with the growth of the economy, as well as demographic factors in terms of population, aging, birth, and that sort of thing. But there are a number of people who have estimated it, and the estimates vary, but they're all very large. One estimate of the fiscal imbalance recently constructed by Jeff Myron at the Cato Institute puts it at $118 trillion. And then Lawrence Kotlikoff, who does a more sophisticated analysis considering all government programs, puts it above $200 trillion. And of course, that's an enormous number, and that represents the difference between it's the difference between the present value of future government expenditures, expected future government expenditures, and expected future government revenue.
Okay, and who holds the debt? A lot of the time we hear about the Chinese holding the debt or the Japanese. How much of this is foreign-owned and who holds all the debt?
Okay, well, if we go and we just look at the formal debt, which is held in the form of Treasury securities, then a little bit over about 55% is held abroad, and most of that is held by China and Japan, about 40% of that 55%, and the rest is held domestically by banks, by mutual funds, by local governments, retirement funds, etc.
Okay, so to what extent would you call the current situation as it relates to the U.S. debt a crisis?
I would say it's a crisis because you've got these promised future expenditures which far exceed promised expected revenue, and a lot of people think of that as sort of, well, that's a problem in the future, but there's a way in which it impinges on the present, because what it reflects, and now we're again talking about the fiscal imbalance, which is somewhere between $100 and $200 trillion. Now we're talking about the amount by which either taxes have to be raised in the future, or benefits for Social Security and Medicare have to be cut, or some combination of the two. There is no other alternative. In other words, you can't. The number will not go away, and in fact, actually, it keeps getting larger and larger as politicians keep pushing the can down the road, as the expression goes. And so, I'm arguing that politicians have no incentive to solve this problem. They will continue to push it down the road until you end up with a fiscal crisis in which all of a sudden investors realize that the U.S. government is insolvent, and then they start putting a risk premium on Treasury securities, and at that point the situation will move very fast, because that increases the fiscal gap, and as you increase the fiscal gap, then the risk premium increases. It'll be sort of like what happened in Greece, only in the U.S. and on a larger scale.
Okay, sure. So, and you've touched on this some already, but how did we get into this mess?
Well, the basic way we got into this mess is social insurance, and the social insurance, broadly speaking, which includes government-provided health care and Social Security, is the flagship of all the welfare states throughout the developed world. And in nearly all of them, it's been set up on a pay-as-you-go basis. In other words, when Social Security was first set up, it would look like a government mandated a compulsory retirement program where people would pay their payroll taxes, and that money would be invested like in a private retirement fund, and then when they retired, they would get the money back along with all of the interest earnings. But Social Security from the get-go was run on a pay-as-you-go basis, which means that the taxes that people pay into Social Security and now Medicare mainly go to current beneficiaries rather than being invested. And so it operates like a giant chain letter. I don't know whether people are familiar with that concept. It's a Ponzi scheme where in order to keep the system going, you have to keep pouring more money in into the system, or otherwise you won't be able to honor those obligations. And so that's the basic problem. And, under certain circumstances, a pay-as-you-go system can function if the economy is growing and the population is growing at a rapid enough rate that you're funneling more and more dollars in the front end to pay people as they receive their benefits, become eligible to receive their benefits. But that situation does not apply to the U.S. today. The economy, the fiscal gap has gotten so great that there's no rate of economic growth that could effectively close it. And taxation, in order to close the fiscal gap, would have to rise to unprecedented levels. If we look at the history of taxation since World War II, the federal government federal government revenues in total have been bumping up against 20% of GDP for over half a century. And even during World War II, they didn't get much above against 20% of GDP, but these programs are going to require government expenditures, even if there's no increase in things like national defense and government operating expenses. It's going to push total government expenditures, not counting interest on the debt, up to 35% of GDP. And so where's the money going to come from?
Well, and on the taxation, we would also have to see a tremendous amount of inflation and money printing, something akin to those trillion-dollar coins that were discussed a few years ago, to be anywhere close to making a dent in this situation.
Yes, actually, there's an interesting sort of personal history with respect to this. When I began looking at these numbers way back in 1993, that's when I first became aware that the U.S. government was going to face a fiscal crisis. And at that time, everybody thought I was nuts. And now, of course, you have people like Kotlikoff at Boston University and other economists all envisioning some type of crisis and recognizing the seriousness of the problem. But a lot of people think that the way it's going to play out is with inflationary finance, with the U.S. government printing up a lot of the money. And I am of the view that that's highly unlikely. First of all, the amount of revenue that the government currently generates from printing money is a very small part of its total expenditures, and that's been true throughout the developed world. So, and also all of these benefits are indexed to inflation. So even if you have high inflation, the benefits go up with the inflation. It doesn't close the gap. So I think that, in other words, what's unique about my perspective on this problem is that I think that it's unlikely that inflationary finance can close the gap, and therefore that it will be used to close the gap, and that rather than that, you're going to have actually the government formally defaulting on Treasury securities, and possibly repudiating the entire national debt.
All right, so we'll get into what that might look like and what that all means in a moment, but I want to touch on one other potential solution here that is brought up from time to time, not necessarily in the mainstream media, although Donald Trump seemed to actually back this for a very brief moment before he changed his mind, just like he seems to on every other topic, but that's asset sales. So what assets does the U.S. government hold right now, and could the sale of U.S. government assets make any type of dent into the current situation?
I don't think the sale of U.S. government assets could make any dent. If we look at the amount of assets that the U.S. government officially lists in a regular Treasury reports, it's only about $3 trillion, and a lot of that is student loans. Now, that doesn't include everything. It doesn't include the gold held by the Federal Reserve, or actually held by the Treasury, but indirectly owned by the Federal Reserve, which at historical prices is valued at $11 billion. Now, if gold sells for $2,000 an ounce, that would go up to about $500 billion, and still that's not even coming close to closing the gap. The government assets that aren't listed and aren't officially valued include all of the national parks and all the land and the mineral rights and the offshore drilling rights that the government has control over. And the Institute for Economic Research has estimated the value of those assets at $150 trillion. And if that estimate were correct, that might come close to closing the fiscal gap. But on the other hand, I think the estimate is too optimistic. And secondly, who are you going to sell all of that stuff to? In other words, the government, if the government has to have fire sales on all of those assets, it's not going to generate $150 trillion. So I don't think government assets are a significant solution to the problem.
Okay, sure.
So, in other words, and I should add to that even if the U.S. government were to repudiate its entire formal debt, the $13.9 trillion that we're talking about, that won't close the fiscal gap either. So the real message is that Social Security and Medicare is not going to be there. Those are going to be the people who are harmed most by a U.S. government fiscal crisis. And none of the reform proposals that I've seen come close to closing the fiscal gap. In other words, if you could evaluate these reform proposals in a straightforward manner, if you line them up, and the advocate said, well, how much of this gap are we going to close by cutting benefits, right? And how much of this gap are we going to close by raising taxes? And what you would discover is that most of it is smoke and mirrors, that they don't plan on cutting benefits or raising taxes enough to close the gap. And so I think that these programs are going to collapse. They're going to go under. They're not going to be available. And the only honest thing that economists and politicians could do is just to tell people that money is not going to be there when they need it and when they expect it. And so to the extent that people anticipate that, they can invest and save in ways that will protect themselves from the consequences.
Sure. So before we look at a full-fledged default or repudiation, let's talk about the debt ceiling and the debt limit. Those issues seem to stir controversies every few years, and I don't think a lot of people know exactly what they are. So what is the debt ceiling or the debt limit, and what are these controversies that we see related to those issues every few years?
My view is that these controversies are pretty much a tempest in a teapot. The debt limit is a formal limit that Congress puts on the formal debt. All right, so it doesn't even apply to Social Security and Medicare, those promises. It only applies to the $13.9 trillion we've been talking about. And so what that means is that when that number starts to approach the ceiling, legally, unless Congress raises the debt ceiling, the government is going to be technically insolvent and can't cover its expenditures. But of course, Congress always raises the ceiling. So I remember I think to make it clear to your listeners, I'm talking about a repudiation of the formal debt of the $13.9 trillion, but that's not the source of the problem. The source of the problem are these unfunded liabilities that raise that number from 13.9 trillion to somewhere between 100 trillion and 200 trillion. That's the source of the problem, and the debt ceiling controversy doesn't even touch on that.
All right. So, what would a U.S. government default look like, and what would some of the short and long-term consequences of that be?
I think that it would unfold similarly to what happened in Greece, and it would be as rapid as the collapse of the Soviet Union. In other words, at some point there's going to be a trigger, and as I mentioned before, currently Treasury securities are considered riskless. So the interest rate on Treasury securities is sort of the baseline, the risk-free interest rate that everyone looks at. And at some point, people are going to realize that the U.S. government faces this fiscal crisis, and all of a sudden a risk premium will appear, and that interest rate will go up. And this can happen very rapidly. In other words, the situation in Greece, when Greece ran into its problems, you had initially they had all this sovereign debt outstanding, priced at very low interest rates because there was high confidence, and then all of a sudden, it very quickly turned into a low confidence environment regime where where investors began putting a high risk premium on that sovereign debt, and that's what initiated the crisis. So that's what I think will happen in the short run. And so if we're looking at the domestic portion of the debt, in the short run, you're looking at about $5 trillion worth of losses spread throughout the U.S. economy, and about $6 trillion worth of losses for foreign holders of the debt. And although the $5 trillion domestically seems like a large number, it actually is only slightly larger than the loss of value during the collapse of the housing boom, and it's much less than the $10 trillion fall in the stock market during the stock market crash that resulted from the financial crisis. So the short-run consequences are going to be painful because Treasury securities are used as collateral for other forms of debt. But over the long run, you have to remember that all debt has an asset and a liability side. So the asset side is the Treasury securities. So if we conceive of a total repudiation, the people holding the Treasury securities, the value of those Treasury securities in a total repudiation would fall to zero. But if a debt is repudiated, that means not only is the asset eliminated, but the liability is eliminated. And the liability, in the case of government debt, is not technically, it doesn't directly affect the government, it affects taxpayers, because the only way the government finances its debt is by collecting taxes that pay interest on the debt. And so the fall in the value of Treasury securities in the long run will be offset by a fall in future tax liabilities of the general public of the same amount. And to the extent that people anticipate their future tax liabilities, that should mean that the value of private assets will go up in value because they no longer face these future taxes. So I think one of the benefits of it, in other words, I'm not only predicting a Treasury default. I think in the long run, the consequences will be beneficial. To put it into a soundbite, a Treasury default is a balanced budget amendment with teeth. It will force a significant government retrenchment, which from my perspective is desirable.
Well, absolutely. And it seems like all of this is inevitable, but how imminent do you think it is? It's obviously hard to predict the timing of this sort of thing, but
yeah, it is very hard to predict
when this will happen.
Yes. I don't have a good idea. I think there are a couple of firewalls that within the government financial structure that can trigger this event. Remember, the what's going to trigger the default or the crisis is all of a sudden a risk premium being put on Treasury securities. So now, why hasn't that risk premium already appeared? And the answer to that question is that Social Security and at least a large part of Medicare, hospital insurance, were set up to look like mandatory government retirement and healthcare systems where people pay in and then receive what they had paid in. So they have these trust funds that represent the extent to which payroll taxes have been invested in Treasury securities rather than going to current recipients. And those trust funds are steadily declining, but they've given a sort of a verisimilitude to the notion that this is actually not a pay-as-you-go system, but a fully funded system. And the Social Security trustees, every so often, or every year actually, look at these trust funds and give estimates of how long they will last. So the Hospital Insurance Trust Fund, according to the last report of the trustees, will be out of money. Their mid-range estimate is by 2030. Their pessimistic estimates usually turn out to be more accurate than their mid-range estimate, 2021, which of course is only 5 years away. So now, once the Hospital Insurance Trust Fund runs out of money, then the government has to get the money from someplace else, and they could pull it out of the Social Security Trust Fund, OASCI, which is estimated to last at least until 2028 or 2033. But once you start pulling money out of that trust fund and moving it into the Hospital Insurance Trust Fund, then that trust fund runs out of money, and eventually the government is going to have to resort to funding Social Security, as it already funds Medicaid and parts of Medicare from general revenues. And once it becomes clear to holders of Treasury securities that general revenues are financing these programs, that could be the trigger, because that may create the realization that the unfunded liability in these programs is actually will impinge on the government's ability to finance its formal debt in the form of Treasury securities. So maybe within a decade, maybe they can put it off for more than that. By the way, I should mention, I actually have two proposals that I think could solve this problem, neither of which is going to be politically adopted. Go ahead.
No. Go ahead. Yeah, what are they? I'm laughing at the fact that they're not going to be politically adopted. I mean,
one is.
Let's hear what they are.
One is Most of the fiscal imbalance is driven by Medicare and Medicaid. All right. If you abolish Medicare, Medicaid, and all of the associated programs today, I believe that you could keep Social Security going with some judicious combination of tax increases and benefit cuts. But obviously that's not going to happen. Now remember, these are pay-as-you-go systems. So another way to solve the problem would be to funnel a lot of new people into the front end of the system paying taxes, and the best way to do that would be to open the borders to unrestricted immigration. And we know how likely that's going to be, especially given the current political presidential campaign.
Yeah, no, definitely. I want to clarify something because we've been throwing these terms default and repudiation around. So what's the difference between the two?
Okay, basically it's a default is a partial repudiation, and repudiation is a total default. So usually in the history of sovereign debt, you see governments defaulting. So a default can consist of no longer paying interest, or as Trump actually suggested, imposing a haircut on Treasury securities. In other words, saying, well, the value of Treasury securities, we're going to drop them by 5%. We're going to drop them by 10%. So in other words, it's restructuring the debt, and that's a nicer term for default. Restructuring the debt so that the burden is not as heavy. In other words, the liability is reduced but not eliminated, and therefore the asset it becomes less valuable, although still worth something. A repudiation would be if I owe you $1,000 and through some legal shenanigans I managed to get away with not paying it. All right? That would be a repudiation. And therefore, you're $1,000 poorer and I'm $1,000 richer.
Sure. Now, you mentioned Greece as an example of default, but what other examples have we seen of defaults and repudiations, both around the world and in U.S. history?
Well, around the world, there, of course, was the Russian default of 1998. And in that default, Russia actually discriminated among its liabilities, and it managed to default partially on its debt, in large part in order to preserve the value of its currency, to prevent a significant fall in the value of its currency. The one example that I like to point to occurred in U.S. history, and that was the state defaults in the 1840s. And the reason I invoke that example is because it's a case where the political consequences were actually, in my opinion, desirable. A lot of states had run up huge, enormous debts as a result of financing infrastructure, most notably canals. And so they had managed to bless the U.S. economy with about 3,000 miles of mostly economically unjustified canals at a huge expense. And then they further increased their indebtedness by, especially in the Midwest and the South, by investing in state-chartered banks. And what happened is that you had a deflation in the economy that began in 1839, and the state governments began facing significant financial stringency. And 4 states defaulted on their debts, as well as the territory of, four states actually repudiated their debts: Louisiana, Arkansas, Michigan, and Mississippi, as well as the territory of Florida. Four other states defaulted temporarily, and the results were, the long-run results were beneficial. Because what happened was that there was this strong effort on the part of the Whig Party under the leadership of Henry Clay to bail out the states. But the president at that time, Martin Van Buren, Democratic president, was opposed to the bailout and managed to prevent the bailout from happening. And as a result, the states began reforming their financial systems. They instituted balanced budget amendments, which is one of the reasons why, although they've been undermined since then, it's one of the reasons why state governments today are not facing the kind of fiscal crisis that the national government is. They instituted general incorporation rather than having corporations established by special legislative act. It ensured that when the next phase of the transportation revolution took place, which involved railroads rather than canals, although the states subsidized them to a certain extent, they didn't own them outright the way they did with canals, and most of the funding came from private sources. In fact, you can date this default as the time when, at the state level, economic policies moved from the old mercantilist system of significant government intervention to laissez-faire.
All right, and since you mentioned them in there, before we wrap up, I do want to look at balanced budget amendments a little more. What are some of the issues with the balanced budget amendments that we see discussed today, and what do you think about the more common balanced budget amendments, or at least the proposals?
Yeah, well, I have mixed feelings about balanced budgets amendments. I would, in theory, support them, but usually they have to contain loopholes. If you look at the history of governments prior to the 20th century advent of the modern welfare state, governments spent more on making war and preparing for war than all other things combined. And in fact, if you go back far enough, governments were essentially war-making institutions that did a few other things on the side. And as a result, if you look at government debt, usually during peacetime, governments ran surpluses. But wars were so expensive that they were always paying down the debt from a previous war. And this is true for the history of the U.S. or the U.K. for most developed countries. So if you have an ironclad balanced budget amendment, it's going to make it very difficult for governments to wage war, which in most circumstances, in my opinion, would be desirable, but you have to consider that consequence. And if you put in a loophole, then the government is always going to find a way around it. It's only in the 20th century that governments began running consistent deficits, and it's only in the 20th century that these deficits were generated not by military expenditures and expenditures for war, but by essentially social insurance.
All right, and going back to the topic of default or repudiation very quickly, some people who have concerns about a default or repudiation may have concerns about the ethics of that whole idea. Do you have any concerns about that?
You're feeding me these questions. Yeah, my view is that I think the default will be accompanied with a collapse of Social Security and Medicare. And if you compare the holders of Treasury securities to people who have been promised Social Security benefits in particular and Medicare benefits to a similar extent, who gave money to the government voluntarily and who was forced to pay into the system. And obviously the Social Security and Medicare beneficiaries were forced to pay into the system. The holders of Treasury securities voluntarily assumed the risk of loaning the money to the government. So from my perspective, it is the Social Security beneficiaries who have from the standpoint of equity, have the more legitimate claim. And so if it were possible to have some way of honoring Social Security to the extent that people had previously paid in benefits, in other words, paying them with respect to the amount that they had paid in, at the same time repudiating all the Treasury securities, I'd be all in favor of that. And in fact, if there were some way of actually making politicians who created the Social Security system and the Medicare system, in other words, the presidents who signed those laws and the members of Congress who voted for those laws personally liable up to their extent of their entire estates, in order to pay back Social Security beneficiaries, I think that would be the most equitable solution. But obviously, that's not what's going to happen. Yeah. So I think that you have to focus on the distinction of of whether the money was given to the government voluntarily or involuntarily. And remember, the government is a coercive institution. And so there is a sense in which loaning money to governments, which collect most of their money, which collect the money they use to pay for the interest and finance the debt through taxation, is akin to loaning money to gangs of robbers and pirates and slaveholders.
Yeah, well, it looks like we're going to have we already, of course, have a messy situation on our hands, but it looks like it's going to get even messier, and it's really going to be bad news for the average American.
I think in the short run, yes, but in the long run, I think that I'm a little bit more optimistic than you are, because when I teach economics, and when I ask students whether they think Social Security is going to be there for them when they retire, almost none of them raise their hands. And if they act on that, in other words, if they plan their life not depending on Social Security, in other words, just treating Social Security taxes as, well, that's money that's been taken away from me and I'm never going to see it again, then the hardship that results from the collapse of these programs can be mitigated. And that's why I emphasize that I think that rather than trying to generate reform proposals that both will not close the fiscal gap and will never be passed anyway, is a waste of time, and that those who recognize the significance of this problem should be telling people, informing them that the Social Security and Medicare at some point is not going to be there, and then they can prepare for that.
Well, I think I largely take the view of being a short-term pessimist and a long-term optimist. I'm just a little concerned about when the long-term optimism part actually kicks in, but we'll see, and it'll be interesting to follow. I want to thank you very much for joining me today. I obviously mentioned this at the beginning of the show, but what are the best ways to follow your work, and what readings and resources do you recommend someone check out if they want to learn more about these topics?
Well, the best way to follow my work is to look at my faculty website, which you mentioned at the beginning of our discussion, and the three articles you mentioned, the one that's available, the first article that I wrote for EconLib on why a Treasury default is likely, and actually I have a longer paper on this coming out in a forthcoming book, although I don't know when the book will come out or when it will be available. But all three of the articles you mentioned are available online. The one I wrote with David Henderson for the Independent Review, the one for EconLib, and the one at Econ Journal Watch. So I would suggest people look at those.
Well, very good. And not only are they all available online, if you go to the show notes page for this episode, wakeupcallpodcast.com/default, they will all be linked to from there, along with your faculty page at San Jose State and the Emancipating Slaves, Enslaving Free Men book that I briefly mentioned earlier. And there's also an article that Murray Rothbard wrote in the 1980s about debt repudiation. So they're all
right, yeah,
to that article too.
Yes, he was an early advocate of government debt repudiation.
Yes.
Remember, the emphasis is government debt repudiation.
Yes, true. Yeah, that's a very important distinction to make. wakeupcallpodcast.com/default is the place to go for all of those links and resources. And while you're on our website, I want to encourage everybody to sign up for the email list so you can stay up to date on what's going on with the show, as well as to subscribe on iTunes or Stitcher or the podcatcher of your choice, and to rate and review the show on iTunes to stay up to date and put in a good word for us as well. So on that note, Jeff, thanks for joining me today to sort through this whole issue of the U.S. government debt and what default or repudiation might look like and the inevitability of them. And thanks so much.
Well, you're welcome. It was my pleasure.
All right. Well, thank you very much.
Thank you for listening to this episode of the Wake Up Call podcast.
If you would like to listen to more episodes, please subscribe, rate, and review the show on iTunes or subscribe on Stitcher. And check out our website at wakeupcallpodcast.com.
There you will find show notes pages and comment sections dedicated to the show. You can also email us at contact@wakeupcallpodcast.com if you're interested in being interviewed for the show or have any other suggestions.
Thank you.